Namaste, sir. Am I audible? Good afternoon, all.
I'm audible.
Yes, sir. Anil sir, namaste. सर आपको आवाज आ रही है हमारी?
जी आवाज आ रही है.
जी सर, नमस्ते सर.
नमस्ते.
Welcome sir. This for this training session, we welcome you.
Thank you sir.
Yes sir. तो आज का हमारा 35th सेशन है और आज का सेशन ले रहे हैं हमारे श्री अनिल कुमार सर जी. सर है सीनियर फाइनेंस एंड अकाउंट्स ऑफिसर एट आईसीआर सीआईटी कोचिंग. तो सर आज के इस सेशन में हम सब ट्रेनिंग और आईसीआरएमएसएम के तरफ से हम आपको हार्टली वेलकम करते हैं सर. और सर आपका ब्रीफ में हम परिचय करना चाहेंगे. तो सर ने आईसीआर ज्वाइन किया है एज एलडीसी इन 1994 एट आईसीआर कोची. Basically, he is a physics graduate from Kerala University. He has promoted as UDC in 2022. He has worked as junior accounts officer at ICIT from 2004 to 2007. He has worked as assistant finance and accounts officer at ICIT Kochi from 2007 to 19. Worked as FAO at KRE from 2019 to 2022 and recently promoted as senior finance and accounts officer in 2022. He has working experience in administration also. Basically, he is finance officer and he has 12 years experience in administration, working in various capacities. He knows coordination, stores, purchase, establishment. Especially he knows basically in administration about purchase, contract services, technical services, and he has also dealt with court cases, and he have been doing audit and accounts related work from last 19 years. Also, he has been preparing working for preparing new format of annual accounts on accrual basis since its inception, that is 2003-4 onwards. Sir, we heartily welcome you, and I request now, sir, you to start the today's session. Now it's over to you, sir.
Thank you, sir. Sir, good afternoon to all. First of all, I thank Dr. Das sir and his team for giving me this opportunity. Moreover, am I audible, sir?
Yes, sir. Yes, sir.
Okay. Moreover, I wish to congratulate Dasji for this great attempt, because this class is actually not only used for exam purpose, this can be used as a master guide to all the ICR staff who are working in ICR system. Because if you have come out with a CD of the entire this class, definitely it will be a great asset to our organization. Now let us come to our class. Madam Sunita Arya Madam, in her class session 16, I think, has already explained about the various schedules of annual account. Hence, we can directly go to, because he has already explained about what are the assets, liabilities, etc., etc. Then we can directly go into our topic, how to prepare the annual account in the new format. It is a very important document, and utmost care should be taken while preparing the same. But if you understand the concept of the annual account and as well as the study in detail all the schedules, we can easily prepare the annual account without much difficulty. Actually, initially the number of annexes were very less. In 2003-4, we have very less number of annexes. Now we are having about more than 20 annexes. That will give a clear picture about all the data entered in the schedule. Then, for preparing annual account, it is very easy. Why? Because if you have taken some interest and some concentration on that, we can easily prepare the annual account, because we have a tallied balance sheet of the previous year. In that, what we have to do is just add the receipts and also the expenditure on accrual basis and on a double entry mode. Then it will automatically come tally and you can prepare the annual account. Actually, there's two types of budget. Budget is allocated in two heads, mainly under capital and as well as under revenue. Capital means for assets that we are purchasing our vehicle, equipment, etc. That is coming under capital. Revenue expenditure means all types of recurring expenditure, like that chemical, glassware, then like that farm expenditure, electricity, water, etc., contract labor, etc., will come under revenue expenditure. In the case of double entry system, for each capital expenditure, we will get an item. Means the balance sheet will tally, because whatever expenditure incurred, we are entering into schedule 1, and whatever assets we are acquired, that will show in schedule 5 and 7. Then it will become tally. Then in the case of revenue expenditure, the expenditure we will book under income and expenditure account, etc. But as a receipt, it is important to note that the government grant as such, we are not entering into our annual account. The expenditure, whatever expenditure incurred, that amount we will take it as a receipt. Then automatically will tally, because whatever expenditure incurred, that we are entering in expenditure annexer. The same amount we are showing under receipt. Then it will also become tally. Then that means we can easily prepare the annual account if you understand each schedule very carefully and also the concept of annual account. Now let us go to in detail about each schedule. Now I will share the screen. I think, sir, can you see the slide, sir?
Yes, sir. Yes, sir.
Okay. Sir, actually, the preparation of annual account on accrual basis started from 2003-4 onwards. Before that, we are preparing the annual account cash basis. That is from some receipt and payment account, and as well as some A2, some I annexes are there. That itself is an annual account. From 2003-4 onwards, we are preparing the annual account on accrual basis on the new format. In the new format, we have 23 schedules. I think about the 22nd schedule, that is the significant account policy. That has already been explained by the Madam Sunita Arya, Madam, in her session. Now we will discuss about the remaining schedules. Schedule 1 to 7 forms the part of balance sheet, and schedule 8 to 21 forms the income and expenditure. And the income and expenditure, one depreciation part of schedule 5 is also added. Means we have 22, 23 schedules, 22nd schedule significant account policy, and 23rd schedule is some note to accounts, and the remaining 1 to 7 balance sheet and 8 to 21 income and expenditure account. In addition to these 23 schedules, we are preparing a receipt and payment account on cash basis. That is 23 schedules, what we have explained is on, we will prepare on accrual basis. Then the remaining R&P account and some annexes, old and new format annual account, R&P account is there, that we are preparing on cash basis. And with the annexes are also there, that we are preparing on cash basis. Sir, you can see the you can be seen the second slide also, sir?
Yes, sir.
Okay, thank you. The method of preparation of annual account. In addition to the income and expenditure data, we have to collect the following information from various section and division, because in case of audit and accounts, we have the data of all the receipt, expenditure, etc. But that is not only, some other data are also required for preparing the annual account. The first one, details of asset disposed of during the financial year along with its book value. Because so many items were condemned and we are disposing it off, then we need the book value, because book value means the historical cost, means the purchase cost of that item along with the realized amount. Realized amount may be total, but we need the asset value and the disposed of the means whatever on auction what we are getting that amount along with the details of each asset and its book value, etc. So we need. The second thing, the value of stock of stores as on 31st March. With whatever stocks available in our institute, means chemical, we are having stock, glassware, stationery, etc. So many items may be in our stock. That we have to collect from each division section. What are the stock available as on 31st March? Then details of all prepaid expenses. Prepaid expense means we are incurring expenditure for next year also. Like insurance we are paying. Suppose we are paying in March, we pay some amount to insurance for 1 year. Means 1 month expenditure only pertain to current year and the remaining 11 months expenditure is pertain to the next year. Like that we have prepaid expenses. That we list of that prepaid expenses also we need. Then details of all liabilities. Liability means many institutes, many bills may be pending. Some contract bill may be pending, lease rent may be pending, the purchase of some bills are pending, all types of pending bills and pending payment list. That is the details of all liabilities. That also we have to collect from every concerned sections and divisions. Then another thing is accrued interest statement of FDs from the bank. Means we are putting some amount or a fixed deposit. Fixed deposit, we are not encashing the amount on 31st March. In that case, some amount may be there. Suppose we are depositing 1 crore in January or February, that we are not encashing that in March. It will maybe for a 1 year or 1 year or 46 days or 3 months like that. Whatever amount of FD available in the bank, for that we need a certificate from the bank of the accrued interest. Then one more thing is there. In the case of SCSP, TSP and NEH, we are purchasing capital items. And the same time, we are distributing the capital item to the concerned person, SC society, SC, NEH area, and TSP also we are distributing many items. That list of distributed item, because suppose we have 10 lakhs as allocated SCSP, so 10 lakhs equipment or what item, capital item we have purchased. Out of that 1 or 2 lakhs, maybe we are keeping with our institute for future use and everything. That can be separately taken into account, and whatever the item distributed, that should be we should get a list of that item also, because that has to be deducted, because we don't have that asset with us. We have incurred expenditure for that asset, but we have not received any material because the asset is not with us. In that case, the list of that items purchased from the SCSP NH also will be obtained from the party. Then, in order to start the account, the first of all we have to do is check the closing balance of annual account with the figures in the accepted annual account of the previous year. Because now we are submitting the annual account to council after validation and everything. Validation by a concerned officer, we are submitting our annual account to council. But once it is submitted, after submission also some changes council may suggest some changes in the entries of data and everything. In some institutes, it has happened also. Some institute may not have made that changes in their annual account in the institute, this one, because they might have printed the annual account and kept it with somewhere. Because before preparing the next year annual account, we have to check, because council will publish, means circulate all the closing balances through their circular. In that, we have to check all the closing balance of our previous year annual account with the data available with the council. Council will circulate before the next or this one annual account. Then the next step, first we have to check the closing balance of annual account with the previous annual account with the previous year annual account with the closing figures of with the council. Second thing, prepare the R&P account, receipt and payment account, or in the old format on cash basis with all the annexes from A to G. Because if the R&P account is the cash basis only, then only we will be able to know when the receipt and payment account is tallied, means our cash account is in order. First, we have to prepare RNP account. We will go to the annexes in detail. RNP account, I will also explain. The step I am telling, prepare the RNP account in old format on cash basis and all the annexes from A to G that are all on cash basis only, not accrual basis. First, we have to prepare on cash basis. Then we can start preparing the annual account in the schedules in the new format. Then, after that, prepare all the schedules initially on cash basis and also RNP new format. The schedules also we can enter on actual expenditure initially we will enter into each schedule. Then we can adjust add liability, etc. will be there that we will do later. Initially we have to prepare RNP account. Then we have to prepare all the schedules with the original figure cash basis. Then we will do the adjustment. In respect of externally funded project, that we have to remember, we are considering only the capital expenditure in our balance sheet. We are not in any revenue, because suppose when a project has a 10 lakh and under equipment and 15 lakhs under revenue expenditure, means revenue expenditure, we will enter only capital expenditure. We are not bothered about the revenue expenditure of the externally funded projects. We are taking only the capital expenditure. Then, how we are doing the adjustment in the schedule? First, we will do the income part. Income part, we have to add accrued income. Accrued income means like interest is there. Some suppose we have to get some rent from, suppose in our institute our one ATM is there that we are getting a rent from State Bank of India. For that, suppose for the March they will give the rent only in April. That income can be taken as an accrued income. Like that, we have to add all the accrued income, because suppose the current year, suppose we got some 1 lakh under revenue, as a rent. The 4,000 rupees has to be get from that party again. Then we have to add that 4,000 also to the accrued income. And then less previous year income, because suppose in the current year, whether we have received any income pertains to the previous year, that has to be deducted. That is in the case of income. In accrued income, I have to add and deduct the previous income. That's from the income part. Then for the expenditure part, so many additions and deductions are there. First, we have to add the previous stock. While preparing the annual account of 23-24, the previous stock means 31-3-23, they might have some stock with us. That they have to add. The second one to be added is previous year outstanding advances. Suppose on the 31st March or before that, for the previous year, we have given some advance to some employee, some LTC advance, some TA advance that has not been settled before 31st March. That we will prepare as an outstanding advance list is there on 31st March. Whatever previous outstanding advance that we have to add to the current year expenditure. Then previous prepaid expenses, that also to be added, like insurance, etc. That we have 22-23, we have made some prepaid expenses. That also to be added to the current year. Then another thing to be added is the liability. Liability of 22-23, liability of 23-24. Because some bill, we know that some bills are pending in our purchase section or coordination section or contract bills may be pending. That bill, that amount, total amount has to be added to the our expenditure in the concerned schedule. These are 4 items to be added to our expenditure. Then, what are the expenditure to be deducted from our account? First one is previous liability. Suppose previous year liability was there, that has been given during this year. Suppose one contract bill pertains to March service, we paid in April. Actually, that expenditure is not pertains to the current year. That is why we are deducting that liability or previous liability during this from the current year expenditure. Then current stock 23-24. 23-24, suppose on 31st March of 24, Suppose we are having some stock, that has to be deducted because that has not been utilized for the current year. The next thing is prepaid expenses. Prepaid, what are the expenses we have already prepaid for 24-25? Means for the next year, that has to be deducted. This I am telling about the preparation of annual account for 23-24. Then the outstanding advances 23-24. The previous 22-23 advance we have to add, and the outstanding advances are for 23-24 means next. Suppose we are giving some advance on 24 March. That has to be deducted. Means outstanding advance as on 31/3/24. That has to be deducted from the current year expenditure. This format is applicable for all the schedules. Wherever applicable, we can deduct. In case of income, accrued income has to be added, and in case of the previous income has to be deducted. Like that expenditure, we have to add these 4 things, and we have to deduct the 4 things from the current year expenditure. That is the main principle of that one. Then let us see this is the format for receipt and payment account. So see, this is the old format. In the old format, suppose you see the columns, you please see. First of all, we are filling the opening balance. Opening balance means the cash in hand, that is interest. Then bank balance, then short-term deposit, etc., are there. This is the closing balance of the previous year. Then we are adding government grant. Government grant is whatever amount we are getting from the ICR towards as a grant, I'm talking about a deposit. Government grant, that budget, etc., and the plan scheme that we are adding under this grant. Then NAHEP, National Agriculture Higher Education Project. If the project is there, that fund can be added here. Then all other receipts, means we are getting a lot of receipts that we will see in Annexure A. Means we are getting consultancy fees, training fee, or sale of publication, sale of other items. All that receipt we have to add here. Then our IR, Institute Revenue Generation, some income is there that you have to add. Then revolving fund scheme, some receipt may be there. Then funded debt. Funded debt means GPF. What is the amount received from towards the GPF subscription and recovery? That has to be added. Deposits means what are the deposits? Deposits means funded project amount. Deposit funded by means project funded by outside agency. That has to be added. Then loans and advances. Now we are having only HBA and computer advance. That recovery and this one receipt from council, both we have to add here. Then non-interest bearing advances. Previously it was there. Now previously some festival advance, everything was there. It is non-interest bearing advances. Now that has been stopped by the 7th Pay Commission. Now we are having only 2 advances: house building advance and computer advance. Hence, this is not applicable in this case. Then remittance 1. We are having a remittance 1 and remittance 2. Remittance 1 means what are the receipts which has to be paid to some other outside agencies like LIC, the NPS, etc., can be here. Income tax, GST, all the receipts can be added here. Then remittance 2. Remittance 2 means the receipt received from the refund from other institute. I am telling means suppose some grant has been given to some institute. If they are refunded that amount of back to us, that can be noted here. These are the receipts of the this one, our old format. Then the expenditure side, what are the first one is the government grant. It means what are the expenditure incurred under government grant can be under one lump sum, it can be posted here. It is an older format only. Then Annexure C means all the grant schemes. Schemes mean plan scheme. So many APSs, so many other projects are there under council. That amount can be added here. Then some grant under non-scheme. Non-scheme the council. Last year, council has given some amount from their non-scheme budget. Some main institute might have got that amount. That can be given in Annexure D. Then borrowing expenditure. Funded debt means again GPF. Deposit means externally funded project. Loans and advance in what payment we have made under loans and advance. Then pension and retirement benefits. That has to be added here. Means total grant we are splitting into 2. Here we have entered only one lump sum, government grant. Here we are splitting into pensionary benefits we are showing separately. The remaining amount will show us here only. Then Institute Revenue Generation expenditure. In non-interest bearing advance expenditure, if any, the remittance already explained. Then grants lapsed in TSA during the current year. Because the grant we have showing the entire amount, actually our TSA started in August 2020. The last first financial year ending na 21st means 31/3/21. Many institutes have lapsed the big amount because nowhere we were not aware about the TSA. Actually, the TSA made actually about on 31st March. It was very difficult to make payment on 31st March. On first financial year, we were not aware of that one. Like that, many institutes have lapsed many good amount from TSA that we have not got it back also. That amount, if any, now we know how to incur expenditure. We will incur all the expenditure by 25th or 26th of March. We will not wait for till 31st March of that every year. Then comes the closing balance. Closing balance, interest, bank balance, everything. This is the receipt and payment account on cash basis, and we have to tally both the side. That is receipt. Once receipt and payment is tallied, means it is cash basis. Our account is okay. Then this is the annexer A. Annexer A to old for some A to G is attached to old format receipt and payment account. These are various head of receipts: sale of farm produce, sale of fish poultry, sale of land, sale of building. Sale of building is capital item only. Then sale of vehicle, machine, etc. Sale of livestock. So many items are there. These are the receipt under various head we are receiving. This we are taking into account for new format also. This is the Schedule B, Annexer B. Annexer B means here we are entering all the expenditure under government grant, detailed one, capital, like that, then revenue, like that. We are entering all the expenditure in Annexer B under government grant. Whatever amount received under government grant, we are on cash basis, we are entering into this schedule, so Annexer B. This is a part of Annexer B, establishment charge, TA, research and operational. This is the administrative expense. The last one is loans and advances. And each expenditure incurred from government grant, and we are reflecting in Annexer B. Next one is under NAH, National Agricultural Health Education Higher Education Program. In that one, in expenditure is there, we can enter into this column. Then this is a non-scheme. Last year, council has given fund under non-scheme budget under 1270. That amount can be booked here. Means those who are not working in accounts or bill section, they may not be knowing about the code 1270. 1270 is the code for establishment charges. And for revenue expenditure means when our grant in aid, general and capital, there is separate code is for depending upon the division. Because in our, we are coming under fisheries division, our code is 90. And for this one, horticulture, it is 86. Like that, every under some head, each head at is the PFMS code. This non-scheme budget allocation and expenditure during 2020, whatever expenditure amount received under non-scheme budget can be entered here. This is the Annexer E. Annexer releases to other institutes under AICRB or many schemes may be there. In that scheme, we are releasing fund to SI, State Agriculture Universities, and ICR units we are giving. That has to be reflected here. Then the details of remittance received from ICR headquarters. That under government grant, NAHEP, then schemes, that has to be because we are getting remittance from council on periodically or every quarter we are getting. The schemes also we are intermediate also we are getting amount. That all thing has to be reflected in this schedule F. This is the most important schedule of old format. This is the Annexer G. This is in this Annexer G, we are indicating the closing balance as on 31/3/23. This closing balance of Annexer G should be tallied with our 9A of the new format annual account. This is a very important document. This is the real closing balance because the closing balance, the total of that closing balance should have been in our account. So cash basis. it should be tallied with our bank balance, cash balance, and a fixed deposit. For each, there is a opening balance will be there, receipt will be there, then expenditure, then refund, then grant lapse under TSA, then the closing balance. The total of the closing balance should tally with our bank account. Bank account means interest plus our current account amount plus FD amount. Then also it should tally with the 9A, means the schedule 9A of the new format account also. Now, let us come to our new format, because we know that there are in the balance sheet, we are having 7 schedules, 1 to 4 under assets, 1 to 4 as liability, and 5, 6, 7 as this one, our assets. Balance sheet, we are having 7 schedules, 1, 2, 3, 4 is under assets, and 5, 6, 7 is under liability. It should tally. Means the total of 1 to 4 and 5 to 7 should tally. Then only we can submit the annual account to the council. Then we can go in detail about the schedule 1. Schedule 1, 2, 3, 4, etc. First is schedule 1. Schedule 1, the first entry is balance at the beginning of the year, means previous or closing balance. Because capital fund means the total assets acquired by the institute during the entire history of this one institute, after deducting the disposed item or condemned item, that should be reflected here. The balance means not the depreciated value, the original value. The original value of the items available with our institute should be reflected. The closing balance should reflect here. Second thing, grants utilized for capital expenditure, means from government grant. Government grant as well as plan scheme. What are the expenditure incurred for capital expenditure for our institute grant as well as under plan scheme should reflect here as grant capital expenditure. The third one, funds of sponsored project, means funded project and project funded by external agencies. The expenditure incurred, not the value of assets acquired. The expenditure incurred and assets acquired is different, because suppose we are giving suppose last March also we have purchased, we have given placed the order and some in the case of works we are depositing some amount to CPWD, but that will keep us advance only. We will not get that building or this one handover to us. We will hand over very later. Then that asset will taken us 5 and 7. But here it has to be entered is the amount expenditure incurred for capital expenditure. And both in the first, second one add capital expenditure. Second one is fund sponsored fund project also we have to add. The next one is net income and expenditure transferred from income and expenditure account. There is an income and expenditure separately we are preparing. One side is income, second side is our expenditure. Then the net result, in a total of that income, that has to be come here. Then the next one is adjustment to capital fund. Here, the one annexer is already how to calculate is already here. The revenue resource generated at the unit minus revenue utilized for revenue expenditure minus recovery of loans and advances. Means see our this is the annexer A. This is the this is the annexer A. This is the total revenue receipts, out of which we have to deduct the recovery of loans and advances. We have to deduct all the remaining this thing. We have to put under this column. We have to show it as an adjustment from capital account. But up to last year, we were not allowed to spend the revenue generated from at our institute. But current year onwards, count the corpus fund, the guidelines has been created. Now we can utilize about 70% of the revenue generated in the previous year can be utilized during the current year. Then now this year, the format, they will change, some changes may be there. Up to last year, we were not permitted to utilize the revenue realized our institute. Hence, the entire amount we will show it here in the schedule 1. Then the balance. That is the schedule 1. Then comes to schedule 2. Schedule 2, normally it is not applicable for us because it is for not companies and all that. They will keep some reserve for giving dividend and everything. But one particular entry we can keep it here, that is the progeny of livestock, will be valued for the expenditure for their upkeep and feed and shown as capital expenditure. The value of the progeny, that we cannot value that, and we will value it as the expenditure incurred for that mother during that period, then the expenditure of that progeny also for a particular age. That expenditure we can put under this one, capital schedule 2. No other expenditure we are entering into schedule 2. Then comes to our schedule 3. Schedule 3 means earmarked or endowment fund. Earmarked fund, normally we are staff welfare fund or revenue, normally we are putting staff welfare fund only under earmarked fund. Under endowment fund, we are putting our award money, because our institute also 3 times they got award. That award money we can put as endowment head, and also the interest earned on that award money, that also can be shown here. And the expenditure incurred on that earmarked fund or endowment, that also we will show here as expenditure. In the in opening balance, addition is there, then expenditure is also there. In that one endowment, in the ICR award, the interest only can be utilized for the expenditure. That amount can be utilized. This is schedule 3. This is the then in the schedule 3, subschedule is there. In that we have to give all the details. What are the awards given and how the opening balance received. Suppose if you get some award during the current year, that has to be added. Or the receipt means maybe the interest also. Interest for the award amount remitted in the bank, that can be shown here. Like that, this schedule can be filled. This is the most important schedule of our the balance sheet. This is a schedule 4. That is a current liability. Current liability means, suppose we have to give some creditors, because suppose if you have to pay some amount to some goods or anything else, that can be shown here. Or advances received. If you have received some advances for any service, suppose any outside firm has given some amount to us for a particular service, and service has not been provided to them, that amount that is taken as an advance, that can be shown here. Then deposit from staff. Normally it will not happen like that. Then EMD security, that we are getting from outside agency, that has to be here. Then all other liabilities, whatever it may be, GPF, etc., that has to be added here. Then salary payable. Salary payable means the salary for March. Suppose if you are preparing annual account for 23-24, the March salary of 2024 that we are paying in April only, but it is our liability. That has to be shown here. That means March salary we have to show here. Then any receipt of ongoing sponsored consultancy project means the closing balance of the funded project. Because what are the projects closing balance available under the various funded project has to be shown here. Then a receipt again, ongoing conference, seminar, etc., intellectual fee, loans and advances, means all the closing balances, all the stock and all the payment to be made has to be reflected here. Then unutilized grant from Government of India, because the receipt, whatever the closing balance available with us, means all the amount reflected in Annexure G. Annexure G, we are already told it is a closing balance of under various head. That all amount has to be reflected here. The only thing is, we are not putting any negative balance here. Suppose a particular project, we have received 10 lakhs on, because some projects now they will not release the full amount. They will give only 75. Then we have to incur 100%. Then after utilizing the amount, after submission of UC only, they will release the balance amount. In that case, some negative balance will be there. That negative balance, if any project is having the negative balance, that amount we will not show here, that we will show in Schedule 7. When the claims receivable, whatever the outstanding, because whatever amount available with us, all the amount of closing balance as on 31st March should reflect here. All the this one payment to be paid, everything has to be here. Then the closing balance of revenue generation, whatever amount received under revenue, sorry. Whatever amount received under revenue, because we that is also a liability. Whatever amount is with us is a liability too, because we have to repay that one. Hence, all the liability under various heads, including salary payable, EMD, etc., all things has to be reflected in the Schedule 4. These 1, 2, 3, 4 is the form of the asset liability side of the balance sheet. Then comes to assets. This is for details of that. So subschedule to Schedule 4 means the details of the project. Project funded by outside ministry, project funded by out of consultancy, project of external funded project, opening balance, receipt, the closing balance. This closing balance, all the closing balance should reflect in Schedule 4. The schedule should come in the Schedule 7 also, that I will tell later. But in the case of Schedule 4, all the closing balance should reflect in Schedule 4. See, this is the Schedule 5. Schedule 5 is the fixed asset schedule. Fixed asset schedule means there are two blocks are there. I think you can see one is gross block and the other is net block. Two blocks are there. One is gross block, then gross block, depreciation, net block. Gross block means the historical value, the book value of the item. Then depreciation is there. Then after the net block, I will explain one item. Then you can easily understand. Suppose one plant and machinery we are having from after the condemned item or disposed item we are deducting. See, the cost of the beginning of the year, addition during the year, deductions during the year, cost of the value end. Deductions means the item disposed of. That we will show here. Then cost to value end means the original cost. Original cost, suppose we have purchased a vehicle for 2 vehicles for 20 lakhs about 10 years ago. And we will, under vehicle, we will put 20 lakhs. Then deduct, suppose one vehicle auctioned and we sold it for, so then that 10 lakhs we will deduct here, the book value will deduct here, the cost to value at the year end is 10 lakhs. Actually, that vehicle will cost maybe for 1 lakh or 50,000 after depreciation. But in the gross block column, we are showing the original price of that item. And then the cost of the beginning of the year means previous year closing balance. This is the cost of the year end. This cost of the year end will come as the opening balance of the next year. Then addition during the year under various head, building, tanks, roads, then to electrical plant, machinery, laboratory equipment, office equipment, vehicle, farm field, computer, furniture, audio, livestock, library books, all items are there. Under various heads, previous year closing balance, we will show it as a opening balance. Then, what are the items purchased during the year? That can be added here. Then, deductions means item disposed of. Suppose I'm condemned and disposed of. In that item, that is why we have initially told that we have to collect the book value of the item disposed of. That book value of the item has to be reflected here. Then the cost value of that. After the one means the opening balance plus addition minus deduction, then we will get the book gross block of the cost value at the year end. This will not go. This amount will not go to our balance sheet. Balance sheet amount is only net block amount. That we will explain later in this one. Then depreciation column. Depreciation column means suppose in the this one plant and machinery, the cost at the year end means the total depreciation what we have made for the years. All the previous year, this is the for the year. Then the total depreciation so far made has to be reflected here. Cost of the value at the year end means the total depreciation so far made should be reflected here. Then the current year depreciation. This is the This is the cost at the year end means cost of the value plus addition minus deduction is the cost value. Then the beginning of the year means the total depreciation so far made for a particular head that has to be reflected here. Then comes to the for the year. For the current year, we have to give depreciation. That means this is the depreciation rate. This is a flatted because we are giving depreciation to the original value. Suppose the for a particular item means electrical installation equipment, the rate of this one is 10% depreciation. Means if when I purchase an item in this year, after 10 years, the value becomes zero. Like that. Suppose in the case of computer, the percentage of depreciation is 20%. After 5 years, it will become zero. Like that, we have to monitor. In many institute, I have seen that some institute I have seen that we are directly giving this depreciation of 20% to the gross block. Gross block means, see, the gross block, this is the cost of the year end. This gross block means the many item might have been, suppose a computer, the computer might have been purchased 10 years ago. That has to be become 0 5 years ago. Now there is no need for, again, we cannot give depreciation to that. Hence, up to 5 years only we can have a depreciation. The 20% can be given. That has to be monitored. Otherwise, we will get a negative balance, over depreciation. Hence, we have to see the depreciation, giving the carefully. We are giving flat depreciation to, there is not the diminishing type of depreciation. We are giving 20% to the cost every year, original cost every year. Suppose 1 lakh we have purchased a computer, means after 5, in the first year itself, the value become 80,000. Next year it will become 60,000. Like that, it will come 5th year, it will become 0. Then again, we cannot give depreciation on that one. So that is why we have to monitor separately, we have to monitor. From up to last year, means 21, 22, 23, 21, 22, we are giving depreciation on a flat method. Means 20% means, suppose an item purchased on March also, we are giving 20% discount. I am talking about a computer. Suppose I have purchased a computer for 1 lakh in March, we are giving 20% discount in April, March 31st. Up to 22, 20, so 21, 22. The 22, 23, the under significant account policy, they have made some changes. Those items purchased up to September, means after 6 months, can be given full depreciation. Items purchased from October to this one, our last period, means March, only 50% needs to be given. Means suppose a computer is purchased in March for 1 lakh, no need to give 20%, we have to give only 10% depreciation, means half the rate. That is one criteria. Another criteria for depreciation is item costing less than 10,000. We are giving 100% depreciation. Suppose we are item purchased at 10,999 rupees, 9,999 rupees, one item we purchased, we will give 100% depreciation on 31st March. For that, a separate list has to be prepared as 5X. Under 5, Schedule 5, we are having A, B, C, D, E, and X. 6 annexes are there. In the Schedule C, Annexer 5X, we are indicating the item costing less than 10,000. In that case, we are giving full depreciation. Suppose we have purchased a computer for 1 lakh and a printer for 9,000 rupees. The total cost is 1,09,000 rupees. For computer, we are giving 20% discount, means the cost value become 80,000. But in the case of a printer, we are giving full depreciation. Means our asset is 109,000 rupees, sorry, 1,09,000 rupees. The March 31st or April 1st, the value become 80,000. The total 9,000 will go as depreciation. Like that, we have to do the depreciation. Then, at the beginning of the year, then for their depreciation is as per the for the year depreciation, we are giving the depreciation as per the percentage given by the already approved by the governing body. This rate of depreciation we are giving to each item according to the nature of item for their depreciation. Then accumulated depreciation. This also we have to see. Suppose item purchased 10 years ago, when a computer was purchased, sorry, 5 years ago, one computer has been purchased. Now we are condemning and disposing it off. Means a computer we have purchased for 1 lakh and we have already in the gross block, it is already there. In the opening balance is there. Now this year we are disposing it off. Means the deductions we will low 1 lakh. Means some amount will be there, 10 lakh or 1 crore computer may be there, 1 crore rupees computer may be there total. Out of that, one computer costing 1 lakh has been disposed of. That will show here as deduction, and our current stock will come 99 lakh only because 1 lakh we have disposed of. Then in the accumulated depreciation column, in the 1 lakh computer purchased, suppose a computer purchased 4 years before, we have given 80% depreciation up to previous year. Means 80,000, suppose a computer is for 1 lakh, 80,000 depreciation is already been made. After 4 years, we are condemning and disposing it off. Because that 80,000 depreciation, which has been given to that particular computer, that we are shown it as here. Means accumulated depreciation. See the formula, total up to the year end. Means at the beginning of the year, some total depreciation is up to the last year, the total amount we are reflecting here. Then we are adding the current year depreciation. Then we are deducting the accumulated. Means in other ways, we are adding to the cost. Means we are nullifying that depreciation. Whatever depreciation has been given for that particular item, suppose 80,000, we are nullifying the effect. That is accumulated depreciation. Then the total up to the year end. Then this is the current year end, means the total depreciation means the depreciation already made up to the previous year. Then current year we are adding, then deducting the disposed of the items depreciation. This is the total depreciation. Means this is the total historical value, means original cost of the item purchased. This is the total depreciation of the particular item up to 22-23, and this is the current year end. Means total cost minus depreciation is the net value. Suppose a computer purchased 5 years before, well 4 years before, 80,000 we has been given as a depreciation. Now the current value of that particular computer is only 20,000. That has to be reflected here. This amount will go to our balance sheet. This particular amount, not the gross block in a total, this is the cost value of the year and is the gross block amount. This will not come to our annual account. The annual account figure, the schedule 5, the figure comes is this one. Total at the current year end. That is the amount which will reflect in our annual account. Means depreciated value. That will only come. And this current year depreciation also we will add in income and expenditure account. This is the amount reflecting in our annual account. The time is also going. This is the AP, same schedule 5 only. This is the APSS fund project. Same thing item. Now APSS is not there. Previously APSS was there. That amount can be reflected here. Then revolving fund scheme. Then deposit. Deposit means 5E is pertaining to deposit scheme. Deposit scheme means the item purchased under externally funded project can be reflected here. Here also the formula is same. All the accumulated depreciation, everything will come here. Next is 5X. 5X is the item costing less than 10,000. We are giving full depreciation. Details of the item we will furnish here. This is not a part of the annual account, but we are showing it separately. Income schedule 6. Schedule 6 is not applicable for us. It is normally filled by the investments that we are normally council only. We are not filling anything in schedule 6. The schedule 7. Schedule 7 is the current asset. Current asset means whatever assets we are. Assets means the closing balance of project and means whatever amount available with us means an institute account, a current account, FD, that amount has to be here. Then all stock, spares, etc. The chemical, glassware, stationery, etc., available on that particular date, 31/3/24 means next year. All that has to be come here. Next, then like that. Then cash in hand, all current assets. Current assets means all the things which are available on chemical, etc. Stock, or the cash in hand amount, cash interest, all the current assets should reflect here as schedule 7. Then schedule 7B is also there. This is the 7B. One more schedule is there. In that one, we are giving the all loans and advances, all means prepaid expenses, deposits, or other earnest money deposit, income accrual means what are the amount shown in Schedule 4 as liability. Many of the items because some current assets, some we are having some 1 crore rupees on FD. The same 1 crore is a liability. The same time it is a current asset also, because we are having that amount in our bank account. That is our current asset. That will show us here. The same time that amount 1 crore is a liability to us, we have to repay that. That is why we are showing it in our Schedule 4. When we see the house building advance, TA, LTC, all outstanding advances will reflect here. Like that, we are filling the Schedule 7. This is annexer to Schedule 7. Then all bank balance details, because now we are opening so many accounts. Previously, we are having only one account with SBI. Now we are having so many accounts with many banks, because for each deposit we are opening with the bank with ICICI. So many banks are there. Like that, each bank details and the balances are to be shown here. Then fixed deposit details. What are the fixed deposit available in our bank? The period of deposit, interest accrued and interest earned, all things will be reflected here. Then comes to about the annexer 7, see the breakup of investment held from FDR. And suppose we have 10 crore in our bank account FD, the details from under which head we have deposited. Government grant may be there, a rolling fund may be there, deposit scheme fund may be there. In all the details we have to give it. It should tally with our receipt and payment account and also the Schedule 7 and all that things, Schedule 4. This is the income part. Income part means all the receipts available under various head, farm produce, fish, poultry, all things has to be reflected here. All the receipts during the current year should reflect here. Then comes in the Schedule 8 also, all the things are on accrual basis only. Suppose we have an income pertains to previous year, that is separate. That we have not shown here. We have to show the income for particular during the received during the current year. Some accrual basis only we have to show here. Then grana, this is a 9. 9 means is a very important schedule. 9 means the opening balance, grant received during the year, all the refunded to council, utilized for capital expenditure, net on revenue account. Means this is the actual expenditure incurred under revenue head. We know that there is 2 heads, capital and revenue. Out of this revenue, we have to show the revenue expenditure. Means actual expenditure incurred should be here. This amount taken as an income, so that the income and expenditure will tally. Because in the balance sheet side, we are taking this means 9 as an income and 16, 17, 18, that is the expenditure. The total of all 16 to 21 is our expenditure. That expenditure, revenue expenditure, we are taking the same amount we are putting in the Schedule 9 as receipt. Means whatever expenditure incurred, we are taking as receipt. Then it will, because the one have the income side, we will put this amount, expenditure side, we will put the expenditure amount, it will tally. The expenditure itself is taken as a receipt. That is a Schedule 9. Schedule 9 means expenditure incurred on revenue account. Then this is the under NHESB and the ICR internal resource also. This is a loans and advance amount. We need more time to explain all these things. But in short, I am telling the expenditure incurred for or a government grant is shown as a receipt. That is same thing amount as taken as receipt. Then comes to 9A. 9A is prepared on cash basis. Means actual, this is not an accrual basis. This is the actual basis only. In actual basis, whatever the opening balance, grant received, grant refunded, grant lapsed in TSA, and the item released to ICR. Many institutes we are releasing fund to other ICR institute. Then total grant utilized for salary, etc., etc. Then the refundable to the government is a closing balance. This closing balance actually should tally with our annexer G. That is a normal format only. This is we are preparing on cash basis. 9B. 9B, we are showing the internal resource. Suppose if we are council is giving some additional fund under from council, that we are showing it as 9B. 9A means government grant. 9B is internal resource. Means these are all income schedule, entrance fees, annual fees, all things we have to show here as a receipt. Then income from investment and earmarked endowment. This we are not filling. So we are not doing any investment. That's we are not keeping any amount here. Then income from royalty, income from sale publication, that also be incurred here. Then interest earned. Interest earned means interest earned on schedule means fixed deposit. Fixed deposit in interest means there's a calculation is there. This is the calculation. Closing balance means whatever amount actually got from the bank through interest. We have to deduct the prior period income. Suppose last year we might have shown as a accrued income, some amount, because last year we haven't received that amount we haven't received this year. That has to be deducted. Then accrued income means March some deposit is there. We didn't get that interest from the bank. That has to be added. That is the in the case of short-term deposit. This is the employee loan because HBA, house building advance loan we have given. That we have given accrued interest. Accrued means in the case of HBA and computer, initially we are not deducting any interest. Interest will be recovered only after completion of the loan. Suppose 25 lakhs we have given HBA. We are deducting every month, we are deducting only principal. After 15 years only, we will start deducting our interest. But every year interest is accrued. The employee is bound to pay some interest. That amount has to be calculated and put it here. That is the then accrual basis we have to calculate and put it as an interest earned. This is the other income. Other income means license fee from cottage, income from guest house, leave salary, pension contribution. Like we know the heads, each head we have to fill it up. So many and this will be there. Income from each head. Then this is the prior period income. Means some income we know. Suppose I know, I already explained that one we have given a building for rent to State Bank of India for ATM. We know that next year we will get 4,000 rupees. That we can show as an accrued income. Some other income may be there which is not calculated. Means it's a we have not calculated that amount. We have unexpectedly we have received some unidentified income. And we have not shown the previous year annual account. That type of income can be reflected here as Schedule 50. Up to Schedule 50 is the income. Now it is Schedule 16. This is expenditure. Expenditure mainly we are divided into 3-4 schedules. One is establishment expense. Established expense means salary and pension. That expenditure we are showing it here on accrual basis, not on cash basis, accrual basis. Accrual basis means we have original expenditure, then we are adding all the previous year advance and prepaid expense, etc. Then deducting the current year advance. Then the amount actually pertains to the particular year only will be entered here in the Schedule 16. Schedule 17 means research and operational expenditure. That is also glassware, chemical, seeds, so many heads are there. That under heads we are incurring expenditure. This is including our government grant as well as scheme, including SCSP, TSP, NH, everything will come here as expenditure. This is Schedule 18. Schedule 18 means all the type of administrative expenditure we are entering here. Security, postage, telegram, newspaper, all so many heads are there. In the we have in one particular show is that loss on sale of asset. That is a particular column. Is there loss on sale of asset? Loss on sale of asset means suppose we have purchased a computer for means 1 lakh for 4 years before. Now we are condemning for 1 lakh rupees. Now we are condemning it. Condemning here auctioned and sold. Then actually 4 years we have a depreciation 20%, 20 lakh, 20,000, 20,000. The current value of the after depreciation, the current value of that particular computer is only 20,000. When we are auctioning and selling it, we got only 5,000 rupees. Then we lost 15,000 rupees because actually the cost of that computer was 20,000. Now we are getting we got only 5,000 or this one 15,000. That 15,000 we can show it as here. Like that, if it is a loss is there, we can show it as a loss on sale of asset. Then this is the grant subsidies to various KVKs, Agriculture Institute, etc. That has to be replied in Schedule 19. Then Schedule 20. So this is the Schedule 20. This one list of this is a list. What are the annexer to Schedule 19? Here we have to list what are the agencies' name, fund released, etc., to various institutes. This is the schedule 20 miscellaneous expense. Under this one, we have publicity, guest house, HRD, etc., is there. That can be shown as schedule 20. Then schedule 21 is a prior period expenditure. Prior period expenditure means unexpected expenditure. Many expenditure we are showing as liability, and schedule 4, schedule 16, 17, 18, we are showing as liability. Because we know that rent has to be paid, the electricity has to be paid, the contract staff payment has to be paid. But some expenditure maybe there is unforeseen, unexpected expenditure. Suppose when due to some court cases or something like that, some prior period expenditure we have to pay. In that case, this is not expected expenditure. This expenditure can be shown here. All the liability expected expenditure means where the liability has already been shown in the previous year. That has been shown in the other schedules, 16, 17, 18. This is the unexpected expenditure which was not shown in the previous year. That can be reflected here. This is a contingent liability. Liability is because it actually we don't know whether the amount will we have to pay or not. Suppose one court case we failed in our CAT. Now the council has gone for appeal in the Supreme Court. Now there is an expectation is there. There is a chance for paying the amount. That type of amount can be shown is here like that. Contingent liabilities like that. Then this is the new format of receipt and payment account. In the new format, the old format, we have shown expenses as single head government grant. But in the new format of receipt and payment account, we are splitting the establishment, administrative, and research. Like that, we are splitting the grant. All other heads are remains the same. Only this one we are having a split up is required in the old format. Remaining the total of the old format should tally with the new format. The total will same, but only thing the different heads are there. But in the old format, only one head government grant. Here, separate heads are there. This is the one annexed worksheet expense is there. Worksheet expense. This is a separate column is there. Suppose for salary, this is the actual receipt and payment account. Means cash basis, the amount will indicate here. Then addition to expenditure. Addition to expenditure means whatever, suppose in the case of salary, the March 24 salary we can add here and March 23 salary. Actually, that salary is not pertaining to this year. Previous year expense. Means for the particular, this one salary, total expenditure we will book here. Then adding the 24 March salary. Then deducting the 23 March salary, this is the net income and this is the amount should reflect in our schedule 16 also. Like type of all adjustments are here. We have to show all the adjustments in schedule 17. All the adjustments are we are showing because addition, deduction, then net. That has to be added here, shown here. Then comes income also, like that only. Actual receipt, then addition to income, deduction to income means previous year income. Addition to income means future to be accrual basis. Next year we are accruing some income that has to be added here. This is the amount. Suppose sale of farm produce, some actual realized maybe 1 lakh. Some addition may be there for 10 lakh rupees to the income because that we have on credit basis you will get only next year. Some reduction means previous year amount we have received 20,000 means total 90,000 will be there. That 90,000 only will come under schedule 8. Like that, all accrual basis only we are preparing the schedules. This is the income and expenditure account. 8 means all the income 8, 9, 10, 11 to 15. These are the schedule. In this case, only the particular item 9. 9 is not an income. 9 is actually the actual expenditure incurred under these various heads. In order to tally with the expenditure, we are booking the expenditure itself as the receipt, because whatever amount we are receiving a government grant, that we are not showing here. Suppose we got a 10 crore rupees under revenue, under grant in aid revenue, we have incurred only 9 crore rupees because 1 crore we were not able to spend. But here we have to show only 9 crore because actual expenditure only we will show here, not the actual government grant received under this head. This is the income and expenditure account, and this net income. This is depreciation from schedule 5 is also here. and the net income will transfer to our balance sheet, schedule 1. This is the balance sheet. Schedule 1 to capital fund, reserve 3, then all the 1 to 4. 1 is means capital, 2 reserve. I already told there is no reserve for us. Only the progeny of that livestock will add here. One thing I will tell you, in the case of depreciation, there is no depreciation for land and livestock. Land, there may be appreciation may be there that we are not adding, because suppose a land we purchased before 10 or 20 years before, maybe 10 lakh, the cost of the current value may be 10 crore. That we will not, we are not giving any appreciation, but we are not giving any depreciation also. Same case in the case of livestock also, we are not giving any depreciation. All other items we are giving depreciation. Then fixed asset means fixed asset and current asset. Fixed asset means what are the items actually received? That is the fixed asset. Current asset means the stock available, means closing stock, fund, everything will come under Schedule 7. This should tally. This is the main issue. When we are, if you fill all the schedules correctly, all the liabilities, means what are the liabilities we have deducted from Schedule 16, 17, etc., that should reflect in Schedule 4. Like that, all prepaid expenses, current asset will reflect in Schedule 7. If you fill all the entries in correct format, definitely it will tally. Because previous year, initially, we were very difficult to tally the annual account. And Sunita Arya madam was also there in council. She also helped a lot to tally the accounts with us, because we were not able to tally the account. But nowadays, it is no problem. When we are preparing correctly, it will easily, automatically, it will be tallied. Then some checkpoints are there. As already time is out, checkpoints means already it is there. A reply to them, and then closing balance, that already explained how to, because we have to closing balance shown in R&P account, Schedule 7, Annexer G, all are should be same. Means Schedule 7 we are giving closing balance of government granted deposit, etc. Same amount we are showing Annexer G also, it should tally. Then Schedule 3 we are showing interest and etc. Schedule 4 giving current liability. Schedule 5, that is a normal this thing only. Then schedule, then nothing. Then last one more thing. Documents to be attached with the annual account. The closing balance statement from the bank, because the bank balance should tally with our Annexer G, 7 and 9A. Closing balance of the bank statement, we will get FD this much amount, this one cash and interest we are having, the remaining amount we will get the bank statement is required, accrued interest certificate from the bank reconciliation statement of all bank accounts, outstanding advance statement, e-Kubar statement, that is TSA, on which shows the assignment limit, utilized limit, and closing balance. All these to be attached with our annual account. Then documents to be attached, then comes to actually, in a hurry only I completed. It is open to, because time is very short, it is open to all. And any queries you can ask. Actually, it needs some more time for explaining all the schedules in some more detail. I can explain, but it will take time. Sir, please, any query they can ask, sir. Sir, one query is there. In Schedule 5, if the net block current year end figure is negative, what formula should be applied? One query, one person has asked. This one is why? Because the negative figure means why it comes. I already explained. Suppose we have purchased a computer for 1 lakh, and we have the depreciation after 5 years, it will become 0. Then we are again giving depreciation to that particular item, means it will become minus. That is the reason for minus. That we have to work out, and in a particular stage, in particular this year, we have to rectify with a negative entry or something like that. We have to reduce the current year depreciation. Like that, we can discuss with the council and rectify once. Once it is rectified, it can be solved out. Now, next year onwards, we will take more care. Sir, any doubt, anybody can ask, sir. There one query is there, what type of question will come from this chapter? Actually, this is not available in any book. Actually, it has to be, it is as an accounts officer, it's a mandate to prepare the annual account. But in the annual account, sometimes they can ask for the this one depreciation aspects. They can ask for the how the depreciation or like that because normally direct question may not come in from this particular chapter. But indirectly, we can ask about many things because when we are not giving any depreciation to livestock, like that, some question may come. Then one more question is there regarding accumulated depreciation. Accumulated depreciation, I will tell you. Suppose we have purchased an item of computer for 1 lakh, and after 4 years, means we have already given 20% discount, 80,000 discount we have already given. Remaining value is only 20,000. And the 4th year, we are selling it out, means disposing the item. Means we are deducting that 1 lakh from our gross block. Gross block means the actual value we are, because suppose we are having 1 crore rupees computer, particular we are sold out this one. Now the value is only 99 lakhs. In the accumulated depreciation side, what we are doing is 80,000 rupees. We have shown as we have given depreciation to that particular item. That 80,000 we are cancelling. By deducting that amount, we are cancelling it, nullifying the effect of depreciation. That is the accumulated depreciation. The depreciation becomes equipment means after 5 years we are depositing means 50% already given. That 50% of that amount shown as the means whatever depreciation we have given to a particular item, that has been shown as accumulated depreciation. That can be deducted. One more question, sir. Kindly explain what all are items under revenue. Revenue means all the expenditure which is not capitalized. Means capital item we know, equipment, vessel, vehicle, library books, computer, everything under capital. All the remaining items, electricity, water, our contract labor salary, farm manure and chemical, glassware, etc., electricity, water, all are coming under revenue expenditure. The assets means definitely we will get some item for under asset. That is as a capital item. Then one more question is there, differentiate between corpus fund and revolving fund. Revolving fund is a separate fund given by the ICR. From that revolving fund, some particular project they are giving revolving fund, and we are revolving that fund and generating revenue from that account. The corpus fund is entirely different. Now only the council has sending new guidelines for corpus fund. Whatever revenue generated by the institute, 70% of the revenue generated in the previous year can be utilized by the institute. It is a great achievement. We have to give thanks to our GP Sharmaji and team, because now up to previous year we are not able to, because those institutes having more revenue means they can incur more expenditure from that account. Definitely some restrictions are there for purchasing capital items, but we can have the permission to use that amount. And those institutes which are not realizing the revenue, the council, we are depositing 30% of the revenue. From that revenue, council, there is a corpus fund. From that fund, councils can give it to other institutes, because all the institutes can't have revenue. Some institute may not be able to earn revenue. For that institute, council can support. Then another question is remittance in explain remittance 2 in the receipt and expenditure one side. Remittance 2 means actually what the remittance received from council. That we can take council or within the ICR system, we are showing it as revenue. Remittance 2. Remittance 2 means whether we are receiving fund from sister institutes, that we are showing a remittance 2, or whatever amount received from other than TSA and grant, we are showing it as remittance 2. Remittance 1 means whatever receipt we are receiving, it is not for us, it is only for a payment to some other agencies like income tax, GSLAS, LIC, all are coming, NPS, all coming under remittance 1. We are getting that amount, same time we are paying to somebody else. That is receipt 1, sorry, or remittance 1. For your information, I will tell you, Actually, previously there was a definition for PQ or STU. That was our account concept. P means P loans. All the loans amount we are doing P. Then Q means Q funded debts. All the GPF fund we are doing Q. Then P, R means R deposit. R deposit means all the deposit. Deposits means the externally funded project we are booking under P, R. Then S means one S advance was there. S advance means in non-interest bearing advances. Like that, suppose we are giving some advances to some particular the festival advance and everything come under this yes advance. Then T means suspense account. That is normally for account purpose only. That is a PQRST. Then U means U remittance. U remittance means receipt received from external side. That is U1 and U2 are there already explained. That was the previous concept of accounting PQRSTU. Now it is not there. Now all annexed schedules and everything are there now. Any refund from other institute can be booked under, refund from other institute can be booked under your remittance too.
Okay, sir. Anybody is having any question? Okay, sir. Now there is no question. So it's a wonderful session. Today's session is very wonderful, sir. We thank from our NISM family as well as from the all trainees, sir. We thank you all very much, sir. सर आपसे आगे भी सर ऐसे ही हम आपकी सहायता की अपेक्षा रखेंगे सर. Thank you very much, sir, for this wonderful session. Definitely, this session will be helpful for all the trainees for their examination. Thank you, sir. Thank you once again.
Thank you very much, sir. Actually, it requires some more time. Actually, 1.5 days is required, sir. Actually, because we were not able to explain. But yes, when the practical comes, they will understand. Because once they started doing the accounts, they can pick up, no problem. Only they know the concept. Only they can aware that. Thank you very much, sir, for giving this opportunity also.
Okay, sir. Thank you, sir. Very much. Today's session is closed.